But before I delve into anything, does anybody have any questions, comments, concerns, topics they want to bring up today? Otherwise, it'll be a pretty short meeting. Okay. And that's okay. So I normally have questions that have come up recently, and so I have a few that I will go over. That usually spurs. You have no sound, Suzanne? Did you look at the bottom of your screen and see if there's a microphone that you can click on? I think everybody else can hear me, correct? I'm getting the thumbs up from other people.
That is correct.
Yeah. So Suzanne, you may want to call Tracy and maybe she can troubleshoot you on that. But there should be a microphone at the bottom that you can deselect. So, okay, she may be reconnecting. Okay. So I usually have a few questions that are either common themes that come up in our meetings or somebody has emailed me. So I will get to those. I will say that we're in the middle of our periodic review meeting. So we meet with all clients typically in the fall and the spring. So that's probably why there aren't a lot of questions right now, because I'm meeting with people either virtually or face-to-face. If you haven't scheduled that meeting and you want to, please do so. We'll be hosting those through November. And then we start our annual strategic planning for 2023. So let's mix it up a little bit. I wanted to kick this off with maybe something fun today, or I think is fun, and that would be 13 stock market facts that maybe you didn't know about. And it does dovetail into some timely topics, I think. But I'm just going to share those with you and stop me with questions you may have or thoughts. Let's see here. Suzanne, you still having problems? Okay. All right. So how old do you think the stock market is? Anybody have an idea?
70. 70.
70. All right, we got to participate.
No. I take that back. 120. 120.
No using Google.
No, I'm not using Google. I'm just kidding, because I said 70 because I was thinking, your mind always puts you in the 90s.
Oh, okay.
Go back to the 20s, but no. But 120 is my guess.
Okay. So welcome to those I just admitted into the room. We are doing stock market facts as a start to this until people have questions. The first fact of the stock market is, how old is the stock market? Jamie has guessed, would you say 120, Jamie?
120.
120. Actually, the stock market is more than 400 years old. And so most people think it started about 100 years ago. It was technically started in the Netherlands in 1602. The Dutch East India Company started issuing paper shares that they could buy and sell. So the first concept of the stock market, you might be thinking of our domestic stock market, it was actually the Amsterdam Stock Exchange is the oldest stock exchange in the world. So there you go. That leads to number 2, which is there's actually more. Let me mute somebody here. And I guess that was Mr. Todd. Welcome, Mr. Todd. Thanks for joining. If you have questions, just unmute yourself or put it in the chat box. And so number 2 is there's actually 60 stock markets or exchanges in the world. And so most people think about the New York Stock Exchange and the NASDAQ. Those are the 2 biggest stock exchanges in the world, but there's actually 60 others. And so we talked about 2 of the American giants, but there's 3 large Asian stock exchanges to round out the top 5 in the world. And so you have the Japan Exchange Group, the Shanghai Stock Exchange, and the Hancock Stock Exchange. And so Switzerland actually has a stock exchange called the Swiss Stock Exchange. It's still 13th on the list, even though they're a pretty tiny country. And so I think that's interesting. Number 3 is something that we talk about fairly frequently. The third fact about stock market is that the market is likely to go up 70% of the time in any given year. And so people think of risk and return and volatility, but if you look at statistics, 70% of the time over the last 100 years, the Dow Jones Industrial Average actually went up. And in the last 40 years, the S&P 500, which is a broader index, actually went up 77% of the time. And so we know that this is historical data, but when you look at a data set of 100 years, chances are it's more likely to kind of repeat itself in the future. Maybe not every single year, but obviously in a longer perspective. Number 4, maybe some of you heard this. October is the most volatile month. Have you guys heard that before? Yeah, some of you are nodding your heads. Jessica says no. Tracy's trying to eat her breakfast, not paying attention. I'm just kidding. So there is a myth surrounding October in the stock market. It's called the October effect. Maybe some of you heard about that. So people think that the stock market declines more in October during any other months. There was 2 big crashes in October that I'm sure most of you have heard about. There was the crash of 1929, and then there was the crash of 1987. Both incidentally were in October. But again, if you look over long-term statistics, more bear markets were actually ending in October than starting in October. And so I'm reading here, the data gets more interesting. These 2 crashes are old enough for most people to ignore. Because of the fewer points, fewer and fewer people believe in the October effect. But I hear about it. I hear about September phenomenon. I hear about the October stuff all the time. If you watch, the talking heads on TV, they talk about it year in, year out. Number 5, September is the worst month. So, we just talked about people believe in the October effect. The same idea, September is the worst month for the stock market. And so on average, 1950, the Dow Jones has had a decline of 0.8%. During September, and the same time period, the S&P 500 has declined 0.5%. So it's actually true. It's a falsehood that September is a really bad month. It's actually the markets have declined less than other months throughout the year. Number 6, I think, is interesting. I talk about this a fair amount when we talk about. Good morning, John. John is joining. Hey, John, good morning. Welcome, John, and anybody else is just joining us. We are talking about some stock market facts for fun today until people have some questions. So we are on number 6 of Lucky 13 stock facts. And so 6 is the United States makes up, how much would you say, what percentage of the world stock market is in the United States? I'm going to pose it to you guys rather than just rattle this off. If you were here, I'd throw candy or something, but nobody's here. Anybody have an idea? Tracy? Oh, she just wants candy. Anybody have an idea? All right, I'm not being a very good school teacher today. Nobody wants to participate. Except for Jamie. So the United States actually makes up only 40% of the stock market. And I've been in this business for 20 plus years, and throughout my whole career, I always have been, encountered people that kind of have says hesitancy. Hey, John, good to see you. Some hesitancy to invest outside the United States, or if they want to do so, they really limit it. And so I think this is really telling that, part of that conversation is when we're building a portfolio for folks, we always recommend to have a sizable amount outside the United States for 2 reasons. One really is the main diversification component of having things abroad. And then the other is there's a lot of opportunity that you'd be missing out on. In this case, as you can see, 60% you'd be missing out on by not having exposure to the international market. So that's always a key component. And so if you were taking a market neutral approach to investing, you might say you would have 40% of your portfolio actually outside the United States. We tend to think that's a little bit high just because of the intrinsic extra risk in international markets. You're looking at political risk, you're looking at currency risk, et cetera. So we generally shave that down, but I think this is important to know what that percentage is. And so if you look at the biggest country stock markets, you have the United States, which is 40. Anybody have a second, guess who is second and third? I'm gonna start calling on you. Tracy, I'm gonna call on you, Tracy. No, okay. So Japan is 7.5, China is 7.51, Hong Kong is 6.5, and the United Kingdom is 4.5. And so we talked about our small country, Switzerland, stands about 2% of the stock market. So most of our portfolios have exposure to all corners of the earth. We do that in a smart way so that we're still getting the best risk-adjusted returns, but getting exposure to a lot of the opportunity. Number 7 fact, the bear and bull analogy actually comes from California. I didn't know this. And so you've probably heard of bulls and bears in the stock market. A bear is somebody who bets on the stock market going down, where a bull bets on the stock market going up. But I'm reading along here. Do you know why we use these animals like this? And so it looks like what they're saying here, I don't know if it's true. I'd have to verify this. My research people here will probably verify my information, but the names come from the fact that a bear is attacking from the top in a downward motion and a bull is attacking from below in an upward motion. So that's news to me. It makes sense. And then let's see, but the origin of these terms, I'd say, is not entirely known, but most plausible story comes from animal fights in California. Who knows? Who knows? All right, number 8, the most expensive share of stock out there. Anybody know?
Warren Buffett's.
I would throw you candy. Who said that? Jamie?
Yeah.
John, you unmuted yourself. You were going to say something?
No, I had the wrong guess anyways.
Oh, okay. We'll get to questions if you have them here momentarily. I just is mixing it up a little bit. Nobody had questions when we started, so I'm just doing some fun facts, and then we'll get back to questions. But you're right, Warren Buffett. Everybody know the Oracle of Omaha. We went through Omaha this summer. I wanted to stop there. I guess you can, if you own one share of Berkshire Hathaway, you get to go to the annual meeting and get a tour of Warren Buffett's. I thought that would be fun at some point because my in-laws are in Michigan, so we make that drive occasionally. Something you can do, Jamie, when you come through from Florida next time. But I don't think you go that route. But yeah, his class share of Berkshire Hathaway, Warren Buffett's, it went over 10,000 in 1992. In 2006, it was worth 100,000, and it's increased tenfold. an increase tenfold in 14 years. It was over 200,000 in 2014 and 300,000 in 2018. I didn't look it up this morning, but it's a pretty expensive stock. All right, 9 out of 13, we're getting to the end. So the earliest investing book dates from 1688. And so if you were already surprised by the stock market's age, Jamie had guessed 120. We said it was what, 600? Let me go back. How many years did I say it was? 400 years old. And so the oldest investing book, which is interesting, was from 1688. So the earliest book about investing is Confusion by Confusions. It's a Spanish book about speculation and investing. And what I found very interesting is that the book is most famous for his 4 rules that still apply today. Number 1, never advise anyone to buy or sell shares, or never listen to advice for stock picking. And so I would agree with that. We don't advise, we see these stock jockeys, as we call them, turn and burn, and they're trying to trade stocks, just don't do well. They lose a lot of money and underperform the market. 2, the second principle is accept both your profits and your regrets. When you speculate, you will lose some money and you need to be prepared. 3, profit in the stock market is goblin treasure. Sometimes profit is high, sometimes it is very low. Number 4, he who wishes to become rich must have money and patience. I like that one. And so, I see this in the business world, but I see this with investors. We want everything to go up at all times, and we want to see immediate results. And anything, whether you're in the accumulation stage or the distribution phase, you're always an investor, but you have to have patience. And 2022, for instance, is a year to have lots of patience. All right, number 10, shares were traded with fractions until 2001. So what that means is it took until 2001 for them to actually use a decimal point. So when you bought a share, you could buy a share at $1 13/16 of a dollar. And I remember when I went to training in Manhattan, we went to the New York Stock Exchange and we practiced being traders. We had to do it in fractional shares, and it never made sense to me. So now you can actually do 12.5 cents. And so that's entirely different, but it took all the way until 2001 to upgrade to the decimal system. All right, number 11, the first stock market bubble dates from 1720. I keep saying 19. And so most people think the earliest kind of recession or bubble was the Great Depression of 1929. You all probably remember the Great Recession of 2009. And if you go back a little bit further, you remember 01, the dot-com bubble. Remember all those dot-coms? And then even further would be 86, 87, but the earliest that they date is 1720, and that was known as the South Sea bubble. The South Sea Company, a trading company in the United Kingdom, was quite successful. And so it looks like the South Sea Company took over the government debt, and there was a big recession at that point. So that was interesting. A lot of the stuff that we're experiencing today, I guess, is the moral here, dates back a long time. And so let's see, number 12, the New York Stock Exchange was not always called that. And so most people, as I mentioned before, know the New York Stock Exchange is the biggest and most famous stock exchange in the world. But it had another name. In 1792, a group of traders joined what was called the Buttonwood Agreement. And that led to this New York Stock Exchange, New York Stock and Exchange Board. And then they changed the name to the New York Stock Exchange in 1863. And then 13, lucky 13 is, let me just read this because I didn't know this, but what does the hydrogen bomb have to do with the stock market? Not a lot it says, but you can find things about it by looking at stock market valuations. So in the 1950s, the United States was researching the hydrogen bomb or the thermonuclear bomb. Physicists were forbidden to reveal which fuel they were actually using for it. And a lot of people got curious about it, but there was a professor of economics, Armin Alchian, I think, discovered that it was lithium as fuel. And you know how he figured that out? Because he saw during the test that the stock price of Lithium Corp rose significantly. The company saw a return of 461% during the primary year of the hydrogen bomb experiment. And so he tried to publish his findings, of course, but the government forbid him from doing so. And it was only much later was he able to publish that. So that was interesting. So there's some facts for you. I do have some questions that have come in, but anybody have anything that they want to talk about or questions? I know John and Suzanne, I think you might be back on. And David, anybody have questions or things you want to talk about? And that's okay if you don't. So I mentioned at the beginning, this is Ask an Advisor session. It's really here just as a channel for people to pop in, ask questions, say hello. If you don't have questions, you can listen to other questions. Sometimes we have a lot of things to discuss and sometimes we don't. So I am going to go through a few questions. Anybody have questions? Raise your hands or put them in the chat. I don't see anything in the chat. Do you, Tracy? No? Okay. And the point is not to put anybody on the spot. I just want to be clear. This is just another channel where people can engage us. I'm still waiting for somebody to put me in the hot seat where I can't answer a question and I have to go research. It hasn't really happened yet all year. So someone's got to do it. Not that I want to have that happen to me, but I don't have all the answers. All right, so
challenge accepted next time.
Jamie. Yes, I had a feeling you were going to say that. Okay, so so we talked about this at the last meeting, but I thought this came up again, and I thought we would talk about it. I will just answer the question in brief, since we have new people here. You may not be familiar with it, but the question in one of our periodic review meetings was about taxed harvesting. And so that is one of the things that we do periodically with part of our ongoing portfolio management. Okay, so from, what are we doing now, for instance? What do we do in a good year and a bad year? We do a couple different things for the ongoing management. One is periodic rebalancing. Rebalancing means we are maintaining the risk and the return mandate of a portfolio. So you can imagine in a 6-month or a year time frame, you're going to get drift, right? You're going to have international markets maybe down, domestic Europe, different classes are performing differently. So we're always rebalancing to bring things back to where we started, and that maintains the risk mandate of the portfolio. So that's important. We are shifting asset classes in terms of where we're allocating funds, in terms of we may be overweighting in one particular area, underweighting another particular area. So that's kind of that's a very high level view of some of the stuff we're doing behind the scenes. But one of the other key points that has a tax implication is harvesting. And there's two types of harvesting that we do periodically throughout the year. One is loss harvesting and one is gain harvesting. And so loss harvesting, which we've taken advantage of this year, so it works particularly well in a down market, and that is actually selling a security at a loss, locking in that loss, and then repurchasing that security back. And what that does is when you lock in that loss, so say we sell something for a $3,000 loss, if you have capital gains elsewhere, you can use that loss to offset the gain. And if you don't have capital gains, you can actually take that $3,000 and offset ordinary income on your tax return. So this is really just a tax strategy that we are doing behind the scenes because there's intrinsic value. You can imagine if you did that throughout a whole year or a number of years, the intrinsic value of that tax savings can actually be quite significant. So this year, nobody likes a down year, but in a down year, we're able to do that. So we've been doing that a lot behind the scenes for folks. And then the other side is gain harvesting. And so gain harvesting, and this is why we want the tax returns from all of our clients, is because it's a tax strategy we look at every year as well. So for those of us that haven't met with me yet this year or this fall, we will want your tax return. We'll want it again in April because we not only do we provide a tax analysis with opportunities, but we use that data to make decisions on the tax harvesting that we do. But gain harvesting is a little bit different, where we'll actually lock in a gain, and that gain triggers a capital gain possibly, But if you're in a low enough tax bracket, sometimes you can harvest gains without a huge tax hit or even a zero tax hit. And so that's really important, where every year when we're analyzing somebody's tax return and where they are in the bracket, we can strategically go in and take out or sell off securities, lock in the gain and pay a 0% capital gain, or even maybe a 15% capital gain, which is still better than ordinary income. So if you're not familiar with that, capital gains have a more favorable tax treatment compared to just income. And the other thing that does is really it steps up your basis. So I know in last month or the month before, we talked about step up in basis, and basis is essentially what you originally paid for that security. So say you pay $10 for it and now it's $20, your basis is 10. And when you sell it at 20, you're going to pay the difference between your basis and the current market value. Well, if we sell and we're locking in that gain, but you pay 0% hypothetically, now your new basis is at 20, right? And so future distributions or future sales will really, because your cost basis is now higher, will be less and less. Is that making sense to people, or is that confusing?
It does make sense, but one question I have is when you do a tax harvesting and sell at a loss and get the tax deduction off of that, that shows up really evident in the documentation we get at the end of the year from TD Ameritrade and stuff.
Yes. Yep. So on your 1099, good question, Jamie. On your 1099, you will see it will actually net out your gains and losses.
Okay.
Yep. So it's nothing you need to do. And so I know I think you do your own taxes. It is pretty self-evident.
Okay.
Yep. And for those who don't, you just provide the 1099 to your tax preparer, or we do for you, and they take care of it. Now, one thing that you need to be aware of, the mechanics, maybe not so much since we're doing this for most people, is that there's a thing called a wash sale. Has anybody heard of a wash sale? If you haven't, a wash sale is an IRS rule that precludes you from actually taking a loss on something if you immediately buy it back. And so there's actually a 30-day window that you have to wait before you buy it back. So it creates it makes it a little bit cumbersome on our part, but so if we sell a security today, we cannot buy the same security back or something that is, the IRS calls materially similar, which who knows what that really means, within a 30-day period. So if you violate that, you cannot take the loss on your tax returns. You just got to be aware of that if you ever try to do it on your own.
Todd, what would be the normal harvesting procedure? I mean, how often do you do that?
We look at it throughout the year, but it just depends. So, year end, we're looking at it more aggressively before the tax year ends, but it just depends on the year. This year, we've been looking at it every month and every quarter.
Okay, thank you.
Is that what you're asking? Yeah.
Yes.
Yep. Okay. So we have another question that came up, and it ties in a little bit to one of our stock market facts. And without giving details about anybody here, I know, John, you and I talked about this at one point, so I think it's relevant. But we talked about that statistically, I think it was the Dow Jones Industrial Average over the last 100 years goes up 70% of the time, and the S&P 500 goes up 77% of the time, if I remember correctly. So that leads to the question about, when I'm sitting on cash, how quickly do we invest? And so we talk about a dollar cost averaging strategy, and I'm pretty sure you and I had talked about this a little bit last year, or last week, John. And
We did.
So dollar cost averaging, what that really is rather than putting money in immediately today, you're putting it over a period of time. And that time could be weeks, months, years even. If any of you are contributing to a 401k or had a 401k in the past, or 403b, 457, you know that that's dollar cost averaging because you're systematically investing. And the theory behind dollar cost averaging and that term really is that if you balance out all those deposits, the average cost, that cost basis we're talking about, probably will be lower because you're averaging your way in. Okay. And the fact is, if you look at the statistics, though, the S&P 500 up 77% of the time, Dow Jones up 70% of the time, is that dollar cost averaging doesn't really work, because if you're doing it over a period of time and the market continues to go up, you're buying in at higher and higher prices. Okay. So I just like to bring that up because it's common to consider that as a strategy. Now, the flip side is, okay, well, if that doesn't really work from a statistical standpoint, why would you employ that strategy? And the answer is because you want to protect the downside. And so, we're investing cash on a daily basis. Typically, we're doing it in large chunks. We're not dollar cost averaging all the time, but there are times that you may want to. If I'm sitting on $1 million for somebody today and we're going to invest, I have no way of knowing what's going to happen tomorrow, next week, next month, the rest of this year, especially the volatility we're seeing now. And, everything going on with the Fed and Ukraine, things are just too much noise. It's creating this, short-term volatility. So that is a reason why you'd want to consider dollar cost averaging. You put in $1 million today, it could be immediately down 5% the next week or 3%. And so that takes an emotional toll on any investor, number one. And number two, nobody likes to start their investing 3% in the hole, which is fairly significant. And so there are cases where we would employ, in a methodical, kind of thoughtful way of dollar cost averaging over time, getting into the markets. And we do that in two ways. One is we're probably going to spread it over 6 to 12 months, depending on the comfort level of the investor and what we kind of perceive as happening. Because generally, a lot of these events iron themselves out in some capacity in that time frame. And so going longer than that probably doesn't, statistically make sense. And then the other is we're probably going to the more guaranteed components of the portfolio. We do more immediately. It's really the riskier stock equity type exposure that we would want to dovetail into that dollar cost averaging strategy. Okay. So I just want to answer that. Questions about that, anybody? Did I explain that okay? Okay.
Thank you.
Sure. Another question came up this week. So a lot of people have part-time employment, or they're doing real estate on the side, or they have some part-time employment, or they're starting a new business or have a business, and they want to put more away for retirement. And so one of the questions I had is, should I create a retirement plan through my business? And first, let me just say, Colorado and a lot of states are making it a requirement for employers to have retirement plans now, which I think is great for the employee. Not so great for the employer because it's an additional. Thank you, John. Have a good day. Thanks for coming. Not for employer because it's more complexity, more cost, etc. But we talk about savings rates, they've improved, but pensions are no longer as prevalent in the society. So anyway, we can create more savings. There's a lot of, I know in Colorado, or in the country, I guess there's millions that don't have a retirement plan at all. And so making this a requirement, I think, is good. And so that's going to be a requirement for any employer with 5 or more employees here in Colorado, and other states are doing something similar. But the question is, for those that don't fall into that category, should I create a retirement plan? And what I always explain to people is that, like everything else, the IRS has complicated the choices here. And some of the states are creating their own retirement plans, it makes it even more convoluted. But there's 4 or 5 different types of retirement plans that a small business owner could have. And rather than getting into them all, what I'll say is that it's like a ladder. And so the ladder goes up in terms of complexity, as well as how much somebody can contribute. So if you think on the ground floor is just an individual retirement account, you would graduate maybe to a retirement plan through your business based on a couple things. First of all, are you already maxing out your individual retirement accounts? Are you able to do that for you and your spouse? And so that's what, 7,000 this year. So that's $14,000 a year that you could contribute. If you're not doing that, then it doesn't really make sense to do something through the business, right? If you have the cash flow and you want to be able to contribute more, then you kind of step up the next rung and start looking at retirement options. And so generally, anything through your business, you are going to be able to contribute more than you can in an individual retirement account. But then it becomes a kind of an ROI, return on investment discussion. Well, how much more can you really do? Is it worthwhile doing it? And then what type of plan programs would you kind of create around that? So you can design plans to be very simple, where you're just adopting a prototype plan from the IRS, to very complex that has lots of bells and whistles, but you can shelter $100,000 per spouse. So that can be really significant for high wage earners. Think, we've done that for, physicians and people like that are making $750 million a year, and you need to shelter that. So that's my quick answer without getting into a fairly complex kind of response to that. But generally, it's how much do we want to contribute? Are we able to contribute more than on an individual basis? And then we can look at the plan design. You have to also consider that you're going to have to cover your employees. So if you have employees, then you will have to, cover them in the plan, which is more complexity, more administrative work, as well as liability. And then frequently there's a matching component that you have to, add to the plan, which is again another cost. So that's my quick answer. For instance, I'll just use one example here, and then we'll move on to the last question I think that I have. So I was working with a restaurant owner recently, and the restaurant owner has 50 employees. And you can imagine that a lot of these are working on tips, a lot of younger people, not necessarily a huge population that is able to and is really thinking about retirement. But they wanted to create a plan, shelter some money from taxes through their business. And so we started to look at things like a 401k plan. So I'm sure all of you have heard about a 401k plan. But my first question to them was, well, what does your cash flow permit? And so we didn't need to go to a 401k plan because their cash flow did not really allow them to max out their personal contributions in a 401k plan. So we've opted for a simplified plan. However, the catch there is that a simplified prototype plan that they're adopting or considering adopting with the IRS requires a 3% wage match for any employee. And so now, yes, they're getting a simplified version, which is easy to administer, is low cost, but now they're required to do a 3% safe harbor match. And on 50 employees, that can be fairly significant. So that's just an example of how that would work. So I know the person that asked this question isn't here, but if you are listening, we will discuss it in our meeting coming up. But I think the IRA, the individual retirement account option, is probably going to be in your best interest for part-time income at this point. So questions on that? Thoughts, anybody? Okay. All right. think that's all I have today. A couple announcements maybe I will make before we go. For those of you here today that are clients and work with us, I just want to seed the thought that I think you already know this, but one of the biggest mergers out there and in a lot of years is TD Ameritrade and Schwab. So we are currently, as you know, we custody with TD Ameritrade. They are now Schwab, even though you don't see that on your statements or your online access. But that transition is happening where all accounts, probably this spring, will be moved to the Schwab platform. So just be aware of that. I will have, me and my team will have additional information on that as we get closer and closer, but it should be pretty seamless. If you haven't signed up at advisorclient.com, that's the online access at TD Ameritrade. You need to do that soon. Otherwise, you're going to be receiving stacks of paper because they'll turn off your e-signature or your e-delivery of documents. And so I've had a number of people call me and say, Todd, I have all this paperwork. What happened? What's going on? And I said, and I had to tell them, don't worry about it, but you didn't register at advisorclient.com, and now they turned off your e-delivery, and now everything's coming via paper. So that's just a heads up. There'll be more coming beginning of the year about that transition and what that looks like. We are moving offices, so people that have been here at our little core office, I know we have satellite offices in accounting firms around the state, but our core office we're moving. I don't know where yet, probably in the downtown area. This particular office building that we're in now is being eminent domained by the city of Colorado Springs, so we are being forced to relocate. So probably my goal is to have a new home probably by beginning of the year, though they've extended the time frame. I think they're not going to force us out until sometime next year, but that's exciting. So Jamie, when you come back to Colorado, we'll have a new spot to visit, and anybody else. And then the last kind of news I want to share with you, just because some of you here are already participating. But if you hear about a thing called the Retirement Resource Center, that was a new kind of endeavor that I started a couple months ago. And so just to kind of give you the overview of that, the Retirement Resource Center is now a new division of Level 5 Financial. I made the decision to create a not-for-profit division of the firm, and that is designed really with the vision of impacting 200 to 300 families by providing free financial education, financial advocacy, and financial planning. And so I've made that offer to really only key clients and friends who would like to pay that forward to somebody that they care about. And so I'm really excited about it. We've already probably had 10 or 15 people engage the retirement resource for unbiased free education. Some of you are here today that are participating in that. And so I'd encourage anybody that wants to be an advocate of that or knows of somebody that might benefit from free education, free advocacy and planning to just have a conversation with me. I'll give you the backstory on why we're doing it and things like that. So I guess the real, just to kind of give you a sneak preview, the reason I'm doing that is the educational component, kind of like today, I've always been passionate about, and it's hard for people to get unbiased, objective perspective. And so if people can get that through their friends and family, it's better than going to Dr. Google or, some of the big shops out there that are really just sales oriented and not advice and service driven. So that's kind of why we're doing it. And so without, I guess that's it. Anybody have any closing thoughts? Are we all sick of Todd talking? So I'm going to call on everybody next month. Oh, one more thing. So for those of you that are in town, we will be having our pie day again this year. Need to get one to Jamie, Tracy. So make sure.
Yeah.
So we like to do it. So as I said, we're meeting with all clients right now that haven't met with me recently, but every year we've been doing kind of a pie day, and I tested it, what, 2 years ago, 3 years ago? And we usually buy pies from a local Dutch bakery here, and now people just can't wait. So we will be doing that again this year. We'll have to find something in Florida. They'll probably ship, but I don't know how well pie will make it. But we can try. Let's see. So that was all.
Bonsai ships.
What's that?
Bonsai ships.
Okay, good, good. All right, we're finishing early. Any questions, thoughts? Anybody have any topics they want for speakers or things that we can do to add service, add more value to this? Just please let me know, I guess. Yeah. Jamie's going to put me in the hot seat next time, he said. So
Yeah, I'm going to try.
I'll have Frank stand in for me next month.
I think you should have Jamie host the next one.
Yeah, I kind of like that.
Can't put myself in the hot seat. That's not fair.
I wonder, so real quick, I wonder, so we've been trying to do every quarter a speaker series, right? I have a speaker come in every quarter, and then we do these every month that aren't really, they're just kind of ad hoc. Would it be helpful to maybe have a speaker come in, or not a speaker, just maybe another professional, and do a Q&A with them or something? Any thoughts on that?
Well, one of the problems is that everything and its brother is going crazy right now. And so it's kind of where you would like to come up with a question to ask, like, what do you think about? I mean, it's just, you could think whatever you want, because it's nobody knows where anything's going. I sometimes wonder where the people's brain are when they think that, oh, well, the Fed's going to stop raising rates, and the Fed has come out and says we're raising rates until the inflation goes through the floor, and everybody goes, well, maybe next month they won't raise rates, and it's like, no, inflation's still up there, they're going to raise rates, and oh, we were surprised that they're going to raise rates. And it's just, sometimes you just wonder about people like that. But it's kind of hard to come up with questions on stuff when yeah, the answer is who the hell knows.
Yeah, I agree, and that's okay. That there doesn't have to be a lot of questions. Again, as the owner of the business, I just want to be accessible to people. It's just another channel. Obviously, I'm here for phone calls and meetings and emails, but it's just another format. So I've come to I'm okay with there not being a lot of questions, and if I can add value, and I know people have given me feedback that these sessions do, I'm fine with that. I'll continue on, but always open to ideas of how we can do things different or better. That was one of the topics I was going to bring up today a little bit, Jamie. What you touched upon is just a reminder to people is that, it's adversity and uncertainty. And so we're in the thick of it right now. And so I'm reminding people of how do we deal with adversity and uncertainty, and what I'm hearing from you, Jamie, is there's a lot of people that aren't handling it very well, and people that have a high certainty need, right? And we talked about the 6 human needs at some time last year. I think it's a Tony Robbins type thing, but 6 human needs, people have a need for certainty. But even those that don't have a high certainty need, these times create an emotional charge where people spiral out of control. And so they start making emotional decisions, or they're just paralyzed and don't do anything. And so I always try to remind people of a couple of different things. And so in closing, I think this is probably good, is one, your portfolio doesn't mirror what's going on in the markets necessarily, or the economy, right? And so generally speaking, 2022 has been a little bit different because both fixed income and equities have been down, which hasn't happened for 12 years. And even before that, it was a very rare event. So this is more of an anomaly. But generally, when markets are down, your portfolios are down less or significantly less, depending on how we have you allocated. But people watch the news and they're watching the S&P. And I have to remind them, well, you're not invested in the S&P. Only this amount is in the S&P. Here's where all your other money is. So it's disconnecting from that. Two is really that emotional component. And so I'll just share for me, as well as other advisors, because I work with a lot of the top advisors in the country. We just met in Denver a couple of weeks ago. And I was talking to a couple of people recently, and advisors are tired with what's going on. And, you know, it's challenging for us. It's challenging for other people. You know, my investments are down, and it gets old after a period of time. So I always remind people that you can do a few things. One is your mental diet. And so I'm very, you guys have heard me talk about this before, I'm very selective of what news and information I let into my little brain here. And so at least for the first hour of my day, sometimes more, I don't look at any news. I certainly don't look at any social media. I only look at news, you know, later in the day in the evening, and I'm selective about that. So I know a lot of people, family and clients, that their mental diet, they're getting this deluge of information coming from, you know, the popular networks, and it does nothing except for create negativity, scarcity feeling, fear, trying to guess what you're talking about, Jamie. What's the Fed going to do? You know, that sort of thing. Thank you, Tracy, for the 5-minute warning. That means I'm talking too much. So I do have a meeting coming up in 5, so I got to jump soon. But so mental diet, what are you putting in? Is it positive stuff? Are you hearing negative? Because most news is negative, right? 2, what's the perspective? You know, the perspective, and we talked about it kind of like long-term trends, and we talked about like the annual returns and inter-year declines that we talked about in the past, you know, that a negative year is typical. You know, they're still, you know, you're gonna have these years, and really has it affected your life and your ability to achieve your goals? For our clients, probably not. So it's maintaining that perspective. And then, yeah, looking at the long-term view, you know, that the markets and the economies generally are an EKG. And we're looking at trends. We're not looking at the day-to-day noise. And so those are all important things for our those of us that are business owners and in the thick of it. You know, taking care of yourself is important too. And so self-care and focusing on, you know, our mental diet, our physical diet, exercise, getting away from this stuff. It all sounds simple, but a lot of people don't do it. And when I really have to kind of walk people off, or kind of off the proverbial ledge when it comes to investing in kind of uncertain times, I can almost tell you 9 times out of 10, they really are not doing any of these things. And so they get caught up in the noise. So I just wanted to bring that up. I kind of went on a tangent on what you said, Jamie, but I think it's important. And I'll just say one other thing real quick. When I met with these advisors, top advisors, they also own firms around the nation. There was a few of them that went all to cash. They took all their clients' money and went to cash. And I've been around long enough, I know that doesn't work. And I think they took the easy button. And I went up to a couple of them after the meeting and I said, did you go to all cash in 07 and 08? No, we didn't. I was like, why did you go all cash this time? You know that's probably not in your client's best interest. And the guy was candid with me. He said, I know. I did it because I knew it would make my clients feel better. And so it was a behavioral, what we call behavioral economics move. And so he knows that in the long term, it's probably going to hurt their performance and the portfolios for the clients, but he knew it would make them feel better. And the reason that ties into what I was saying is I have to have the right mental diet to lead myself and lead my clients to do the right thing. And it would be easy to go to cash and just sit on the sideline, but I know that's not in your best interest. So food for thought. We all have to kind of follow that same protocol. I have 2
Todd?
minutes. I gotta go. Yes.
There was a question in the chat.
Oh, was there?
Mr. Todd asked about his 401 is invested in index funds. What are your thoughts? Did you see that?
I didn't see that. No, for some reason my
And,
chat's not showing.
And then it says, it seems to be, what is this? Let me just read it if you can't see it. My 401k is invested primarily in index funds. What are your thoughts on these? Also, I watch PPU or PPI. It seems to be more accurate than the CPI to calculate inflation.
Yep. I only have 1 minute, David, so I'll follow up on the inflationary question because it's a little bit more detailed, but those are great questions. So I will just say, sorry, I missed that, David. I was too busy talking. But thank you for Jessica for letting me know. So I like index funds. I think that there's been a debate between actively managed funds and index funds for many, many years. I'm a little biased because I worked for 6+ years in the founding of the index fund, Vanguard. But I've looked at all the research and I've been doing this long enough that I still like index funds. And again, there's 3 reasons really that I like index funds. It's not necessarily for your 401k, but one is index funds tend to be lower cost. Cost is actually the most significant predictor of future performance than any other predictor. You know, any rating service or any past performance, they don't predict future performance, but cost does. So index funds tend to be lower cost. For non-401k plans, they tend to be very tax efficient. And so that's why I like them too. Not relevant to you, David, in this case, but that's why we use them in taxable accounts. You see a lot of people in a down market right now. Those actively managed funds are kicking out capital gains to people while they're losing money. And so they have a tax bill on a losing investment. And so that hurts. And so, but still that the reason that they're creating that tax bill and those capital gains is because they're churning the accounts, trying to outperform the markets. And so those actively managed funds tend to not outperform the market. They actually grossly underperform the market. And that's why they're trading so much and are very tax efficient. That's the third point that I like index funds, is that typically they outperform their actively managed counterparts. And so if you look at the data, about 85% of index funds outperform actively managed funds. And that's generally because of the cost drag. It's that human element of trying to outperform when they can't. That sort of thing. So I do like them, but I will, one last thing, David, before we go, is if you take a portfolio that's all index funds and a portfolio that's a blend of index and active funds, the risk actually goes down in having a blend. So I do like a blend sometimes of some active and index funds, but I think, you know, for the most part, people are going to be quite successful just using index funds alone. And even Berkshire Hathaway that we talked about at the beginning says the typical investor they all should use index funds. So I will follow up with you on the inflation question. That's a good one. And if anybody has any questions, email me, give our office a call, and we will see you next month. Thank you for being here, everybody.